Welcome to the Profit Answer Man, Ed Patton. It's great to have you join us today.
Thank you, Rocky. Appreciate you having me on here.
And I am excited for the conversation. Can you share a little bit about yourself and your business?
Sure, I'd love to. I appreciate that. And I'm a finance person for privately owned businesses. I'm a one-man operation in San Antonio, Texas. And what I do is my background is general accounting. I've been a CPA at one point in my life. I don't keep up with continuing education, so I'm no longer an official CPA. I've worked with a boutique investment banking firm here. We did a lot of work throughout the state of Texas. And so through that process, I've always enjoyed working with privately owned businesses. And I've been both sides of sort of the financial fence, and that is generating the financial information from my old accounting days to working on investment banking transactions, helping people buy businesses, sell businesses, raise debt money, raise equity money, just general capital transaction situations, always with small to mid-sized businesses, which range from early stage to about 100 million in sales. And a common theme of these companies is that the leaders of these businesses, very smart, built great businesses, created a lot of wealth, create a lot of good paying jobs, but they don't really understand the financial side of the business. And the reason they don't is because it's never explained to them in a succinct and understandable manner. So that's what I do. It's taken a while to develop a system. It works. It's generated just from existing information the businesses already have. And then it condenses the full financial profile down to 5 elements or 5 items. And each of those items are then condensed down to one number each. So you can really get your full financial profile with 5 numbers. I mean, you're going to need to dig down, later. But first of all, see the big picture. So that's what I do, and I enjoy doing it. I'm passionate about it, and I just want to make sure businesses understand their full financial profile.
And I think we're in alignment there. I love helping businesses. I love helping them make money and keep money and remove money from their business because, the reality is life keeps changing. And when you've got money outside the business, you can weather the storm, which is the most important thing. Survive for tomorrow, and then we'll figure it out from there. So you're saying that people can understand their business with 5 numbers. What are these 5 numbers?
Well, that is correct. It's cash flow, operating earnings, financial health, value, and borrowing capacity. And so I have 2 proprietary reports. One is the cash flow statement. And I do that because, in my opinion, the GAAP cash flow statement is ineffective. And the other proprietary item is the financial health or liquidity. And that's in a dollar amount. So business leaders can understand, boom, here's your financial health in a dollar amount, not a ratio. And then it also shows in there a company of your size should have a financial health dollar amount of this. So you can see, are you above that line? Are you below that line? So very easily you get to see if you're financially healthy. And so, there's more depth to all of this. Plus the fact I just roll all these up together. And let me say one other thing, Rocky. What I've also done on these 5 elements of financial fundamentals, I've defined them, calculated them, summarized them, and reported them. And so that's a pretty big deal. Most accounting and financial advisors don't really know what financial fundamentals are. And so when you talk to them about it and you ask them what financial fundamentals are, most of the times it's a deer in a headlight look. And so, I'm always kind of scratching my head and wondering, I wanted to be a financial advisor to businesses, and how could I do it if I didn't understand financial or didn't understand fundamentals? And so you need that in business. You need it in all aspects of life.
And that is so true. And I agree with you. I think part of it is because they're all trained to use a certain way of doing things. You
Exactly.
mentioned GAAP accounting.
Exactly.
And the problem with GAAP accounting is it's not designed for business owners. And so the underlying system doesn't give them the information that they need. So let's start. I know you mentioned cash flow.
Okay.
I know for our business owners, if they've got good systems and processes in place, depending on who they are, we can usually manage their cash flow with them spending about 15 minutes a month, just taking a look at expectations, moving some things around on a spreadsheet, and they've got pretty good clarity. How does it work with your system?
I call the work I do, I call it the trenders, because clients, it shows trends. And so clients just start asking this month's trenders were ready. So I call them trenders. I've trademarked that. But back to your cash flow question, it's first of all, this is all high level to start with. And so it starts with any cash flow statement shows you the change in cash. And so this does the same thing, but it breaks it down into common sense business perspectives. Operations, which is basically EBITDA, non-operations, which is CapEx, debt service, taxes. And then the sum of those two is what I call foundation cash flow. So then the difference between that and the working capital components is a change in cash. I'm going a little bit too much into too many numbers here. But what's interesting is, Rocky, people know the left half and the left half and the right half of the balance sheet balance. Well, what people don't look at, and I learned this through experience, is the top half and the bottom half of the balance sheet also balance. And the reason they do that is because since probably about the 1500s, people have been using double entry bookkeeping. And so therefore it has to balance. And so this is insightful. A balance sheet does something, it balances. And so what's interesting, so what does all this mean? But what it means though, Rocky, what's interesting is the bottom half of the balance sheet is where the real business and economic activities are recorded on the balance sheet. It's equity is where the P&L resides, the net P&L. Fixed assets is where your equipment resides. Term debt is where your loans reside. So that's the bottom half of your balance sheet. It equals the top half, which everybody knows the top half is current assets and current liabilities. You subtract those two and you get working capital. Same thing, you go to the bottom half of the balance sheet, you subtract those two, they equal the working capital, and I call that foundation cash flow. So what this does, it shows the change in foundation cash flow, which are the business and economic activities. Then you start to look at, everybody on cash flow focuses, and I shouldn't say everybody, but if I had a nickel for every article or whatever I wrote about you need to manage working capital components well, receivables, inventories, payable. If all of us had a nickel for every time we read about that, we'd have a really large stack of nickels. But as far as cash flow goes, that's the tail on the dog. The main thing is the foundation cash flow. Then you look at the working capital components or holding tanks. Those are really holding tanks. And yes, you need to manage those well, like you need to manage all aspects of your business well. And so first, if your foundation cash flow is positive, you're creating financial health. If it's negative, then you got another problem. But see, first of all, are you creating working capital? Then that's through foundation cash flow. Then get to see, are you managing those holding tanks well? And so then that's it. So I'm sure I made that as ununderstandable as possible. Anyway, sorry about that.
So for those of you listening, if you think about profit first, the holding tanks are your different bank accounts. And so it's managing the cash in those bank accounts. And that's the simple way we do it with profit first.
Sure.
One of the biggest issues that I have found with cash flow reports is the QuickBooks cash flow report is just horrendous. You can't understand it. Even I can't understand it. The other problem is people don't always do good reporting, meaning they're not properly reporting their loan payments and everything else, which then affects what you were talking about.
Absolutely.
And if it's not done every month correctly, meaning you're getting your loan balance statements and putting the right entries in, you don't have clarity on that. And so those are the two biggest problems that I've noticed. The other thing is people just look at cash as all the same. And what you're basically saying to us is your business through its operations needs to create a positive cash flow from the business operations, not from borrowing, not from changes in debt, not from all this other junk that goes on, but from that simplicity. And if you can do that, everything works out. And there's a million different factors to this. We've covered it before. It's understanding how they all flow together and what caused that change. But at the end of the day, if more money is coming in from your business than is going out, forget about all the loans and all of that, then things will generally go well.
I agree, Rocky. That's well put. And
So,
especially from your business, from being, as you've already said, but it's not from loan receipts, or it's really not collecting receivables from 3 months ago. It's from what's going on this month in your business, and next month and next month.
exactly. So we talked about one of the numbers, cash flow. The other, did you say financial health?
Well, I did. Okay, but the five are, there's cash flow, and then there's operations, which you've already alluded to, is how much is the operations generating, and basically that's EBITDA. It's a little different, but it's basically EBITDA. And it's really that's your business right there. That is your business. You've already said it. Is that number covering all your other costs? Now, if it doesn't, you're going to have to go grab that money somewhere, but anyway, so those are the first two, the cash flow and the operating earnings. So those are cash flow. Those are really a means to an end. And the other three are then the capital items. And there's financial health, value, and borrowing capacity. And so those are the five.
So if we looked at financial health, what do you consider financial health?
Sure, sure. First of all, let me say what it is not. Most financial health is, when it's discussed, it is current ratio or quick ratio, some kind of ratio. And again, you're talking to people running businesses that are designing products, they're building products, they're hiring people, they're worried about the competition, they're doing this, that, and the other. And you come in and tell them, Rocky, you've got a financial health problem. Your current ratio is 0.95 to 1. It ought to be 1.35 to 1. You're going to go, well, what does that mean? And if you ask me that, I have to tell you, I don't really know. I'd have to tell you a higher number is better than a lower number, but other than that, I really don't know. And so, again, like the cash flow, I've got one other proprietary report, and that is the liquidity or the financial health, which is it's cash on hand plus availability on the line of credit, because you can go on the phone and you can go on the internet, get that money. Less past due payables, because you can always build up cash by not paying your payables. Then less one other thing, and that is upcoming big payments like taxes. I try to get companies to accrue 40% of their earnings to income taxes every month. I'm not always successful with it. I get pushback from actually their accountants and sometimes their bankers. Anyway, but the sum of those numbers gives you your financial health number. And what I found over time is that when that number is at or above 1 month's cost to run the business, you're healthy. And so I'm not sure why it's that number, but it's just, anecdotally looking at a lot of businesses across the board, it works. And so just say your cost to run the business is $1 million a month. And if your liquidity is $1,250,000, you're in great shape. And this is all graphed out each month, so you can see it visually. Now, it should be $1 million. If you're 750, that's not the end of the world. You're below $1 million, but you're above zero. Where you really start to worry is when you start heading towards zero. That's when you really need to start making some changes. So anyway, that's my financial health calculation, if that works.
It does. So just to convert this into the world of profit, first, accruing taxes is your tax account, where you take the money every month, you allocate it to the tax account, you're covered. When the tax bill comes, you stroke a check, you don't have to worry. It's ready to roll. So that's the way we do that. Very similar way to kind of what you're talking about. I will say this, I don't like 1 month of cash in the bank, because especially
it's 1 month. It's 1 month of liquidity, which is, again, cash availability on the line of credit.
And I understand that. But small businesses go like roller coasters.
Yeah.
And so in my world, the more cash you have to cover multiple months of expenses, the better you sleep, the less you worry about payroll, the more you can figure out when things go wonky, because things go wonky. And I know business owners can't stand having a few months of cash in the bank. I tell you, it is the most peaceful thing in the world. So the more cash in the bank, or the problem with access to cash is when things go wonky, the bank goes, oh, we changed our mind, click. And so that's why I like real cash.
No, Rocky, look, I really, as I said, I really don't know why 1 month's cost is the number, but experience has shown that it works. So, and really, and let me say this too, I don't care if somebody uses 1 month's cost, they have some kind of benchmark. that they're continuing to follow. So is it 3 months of payroll or 1 month of cost or whatever the heck it is? But just make sure you've got some kind of target out there you're shooting for.
No, and I agree. I have always been ultra conservative, so I like
Sure,
really
sure.
high targets so that when things go wrong, it's not an emergency in the moment. We got a little time to think through it. The other, you talked about value. Can you expound on that?
Sure. And this is it's a generic valuation, and it's trailing 12 months. I mean, again, all of this information it's in your existing financial information. And so it's trailing 12 months of operating earnings times a multiple, which is subjective. I like to use a conservative number on that. And then subtract from that, add back numbers, do an estimate of that. Again, I'd rather be high to be conservative. And then that gives you the enterprise value. And then subtract the interest bearing debt of cash from that. And then that gives you your shareholder value. So again, it's not rocket science. And some companies want to use, my industry uses a multiple of sales. Well, we can change it around to do that or whatever. But again, just the point is, so you've got some measurement. And again, this is all graphed out. There's a table to show the calculation. There's graphs. Excuse me. There's graphs to show which direction it's moving, and so it's good information to have.
And I agree with you. I think you said something that's really important. All the financial reports have all of this information that we've been talking about.
Exactly.
The problem is the way it's presented is not the
Yep.
best. And what we've learned to do is we take the information in the way that it comes, and then we will reformulate it to the way that we like to present it without messing with their QuickBooks or their accountants or their bookkeepers systems or whatever other requirements might be out there. Sometimes we work with franchisors. They've got their set accounting system. They can't do things differently. Other times their CPA is doing it for a particular way, and that people keep messing up the books. And so what I've learned is, give me what you got. I'll make it look the way we want it to look so that you understand your business clear as day. And that's a big part of it. It's all there. You just got to look at it correctly. That's all.
Yeah.
And that's the problem.
Yeah, I agree 100%. And that's, I do the same thing. I condense the balance sheet down to a few numbers. I condense the P&L down to a few numbers and then run with the template. But it's, I always, you got to tell companies, these are your numbers. These aren't my numbers, but they're put in a format that you can understand. Let me, you had alluded something, I wrote something down. Let me just bring it up now, but that is kind of talked about how GAAP is difficult to follow, difficult. It's not really written for private businesses or business owners. Yeah, Rocky, what's bad is the GAAP rules, they're getting to be like the tax code. I mean, they're getting to be so complicated that nobody can understand them. And so it's crazy. I don't know why they do that, but they do it. They move away from basics, and it makes everything more complex and less understandable.
Well, actually, there's a good reason for GAAP. And here's what it is. When a company tells Wall Street they're going to deliver X amount of revenue and X amount of profit, they want to deliver it. With GAAP accounting, we can take your numbers and make them look like whatever you want Wall Street to look like. You can move stuff around, play all kinds of wonderful games, and as long as it's GAAP accounting, it's acceptable. And that's why Warren Buffett says it's all BS.
No, that's right. And for the privately owned businesses, they have to have real cash. They have to have real cash flow. So it's not a game for them. It's reality.
And you don't have the money to play the game like the big boys do. In other words, they're creating shell corporations and leasebacks and all these weird, wild things that we don't have the ability to do. So we got to play by our rules. And that's why I love the concepts of Profit First, because it's real cash. We know it's there. We can see it in the moment, real time. And that's what's so helpful. The last thing you talk about is borrowing capacity.
Yeah.
So let's dig into that.
Rocky, the yard guy's right outside the window here, so if I get drowned out, I'll repeat myself. But and when I'm talking about borrowing capacity, it's the amount of term debt supported by cash flow. And so as far as the line of credit goes, that goes back up to the financial health situation, how much is available, and that's just monetizing receivables. So you put that aside. So this is how much term debt is supported by the cash flow, and so again, this is this is not anything proprietary to me, but it's just taking trailing 12 months operating earnings. I take out an estimate for taxes, whether you're paying your taxes or not, then less interest on a line of credit, less capex, and we'll put down if we need to an estimate for maintenance capex. If you're spending 100,000 a year in capex, but only 25% is maintenance capex, we'll put that in there. So that's really your cash flow available for to service term debt, and so you put that number in there. Then you just like to see a coverage number, a coverage ratio, 1.25, 1.35 to 1, whatever it is. So then that gives you the cash flow available to term debt. Very easily in an Excel spreadsheet, you can put the number of years of a loan and the interest rate, and it'll give you how much term debt that cash flow supports. And then you subtract existing term debt or capitalized leases, and then that gives you how much more you can borrow. So really those two, the value and the borrowing capacity, are more of the long-term capital items. So generally that's not something you need every day, but it's an indication. When you look at the trends, it's telling you something's going on in your business. Then when you do have a capital transaction or event coming along, boom, you've got the information right there.
And that's the key, planning ahead, because things do happen, and knowing what your options are. I think for me, I noticed during COVID what the government did in handing out money to business owners and making it too easy, and also just not realistic. Like they were just handing out money like candy. And the smart business owners, they took the money, but they didn't spend it.
Right.
Unfortunately, a lot of business owners took the money and they spent it on daily operations and put themselves in the negative. And they didn't realize it because you know what? There was tons of money in the bank. It all looked good until there wasn't. And now they're going to be paying that loan back for the next 30 years. Well, that's brutal. And I don't think they realize that they all signed personal guarantees if they took a larger amount. So that means you're on the hook. To me, that's just not a place of rest.
No, you're right. I mean, it boosted your liquidity in the short run, but it was, as we talked about earlier, it wasn't from operations. It was almost from a lottery ticket. And so, you're not going to win those very often. And so you can't depend on that.
No, and I think this is probably 2024 tail end of all the lottery money, as we'll call it.
Yeah.
And going into 2025, people are going to have to figure out, make sure they can run on operations, and you're selling enough to cover everything and to be able to do it. And the problem is if you don't have clarity on the numbers, then how do you make the right decision?
That's the key. That's clarity, and you understand them. Make sure you understand.
Yes. Well, and I think that's part of it. If the people you're working with don't make it understandable, find people who will.
Rocky, I had a client that whose soul had a really, really successful exit, but we'd have an annual meeting with the bankers, and he would handle the operation side. I'd handle the financial side. Great guy, built a wonderful business. And he said, I really am not sure what Ed's telling me here, but he tells me when I'm getting near the fence line. And so I need to rein myself back in. So, but at least, he would admit, and he knew he had somebody covering his back. And, and that happens. Some business owners want to get in and dig through this and understand it. Others want to go just, hey, be there and tell me what I need to know when I need to.
Do you find a lot of business owners actually want to dig in and understand this? No. Let's just put that out there. It's not the part of business most of you like. So find somebody to help you do it correctly, show you where your fence posts are, and help you to make the right decisions. And honestly, that's one of the biggest things I've learned is understanding the business owner and their risk tolerance. A lot of business owners tend to not have any risk tolerance. And what I mean by that is they don't even know that the word risk exists. Whoa, we got to put some fences around these crazy ideas. And you got to show me that it's going to pencil out when we start. And then you got to show me that once you get going, that what you said is what's actually happening. Because if we're not on track, we got problems. And so we like to make sure that we are always on track. And We've got the right goals set, and we do it like you do it, simplicity.
Yeah.
Like, how do we make this simple, easy, understandable? And then every month we're focused on surprise, this, that, changes, forecasting,
Yeah.
and being able to predict the future. And that's what I love. I think for my best clients, they're sitting on amazing amounts of cash because we've made the business more profitable.
Yeah.
And so the cash starts to build up nicely. And we don't necessarily spend it just because we have it. And they've got the forward looking systems in place to say the next 3-6 months are looking good. Okay, here are my action items for the next 30 days. Here's where I need to focus. Here's what I need to fix. Let's figure out how to do that. And off we go and running.
I agree. And Rocky, I agree 100% that the two categories I say there's finance and there's operations, and so those are not the same things. And so understand the finances, then you got to do it both, hand in hand. And but understand the finance side part of it, and then start making improvements to the operation.
Correct. And what I say a lot of times is the negative profit sometimes is found in the bad operations.
Yeah, no. I'm not saying don't do it, but
No, I
yeah,
know that, but
yeah,
they are tied together. Bad operations results in no profit. And sometimes the numbers just don't make sense. And you start looking at them and you're like, I'm telling you what, here's what I think the problem is. And sometimes it's a pricing problem. They're just not charging enough. There's a whole variety of different levers that we look at. And once we realize which lever is wrong, then we can focus on correcting it.
I agree. And this is how it affects the overall high level picture.
Yeah. Any closing thoughts of anything we didn't cover today?
No, but Rocky, I just think these are great conversations for businesses to have, for business leaders to have, and those who advise them. And just like, guys, just make sure, whether it's you, me, or somebody else, make sure your client, your boss understands the finance side. And there's one quote I like. There's a lot of great quotes, but it's an Albert Einstein quote, and that is, I'm sure you've heard it a million times, but if you can't explain it to a 6-year-old, then you don't really understand it yourself. So we all have to kind of put ourselves in that, ask that question. Can I really explain it?
And I'll take that one step further.
Okay.
If you can't explain what your business does to a 6-year-old, then you got a marketing problem. Because nobody understands the problem you solve and the value you bring.
Yeah.
And I think for a lot of businesses, that's truly the case as well. These are universal principles. They apply to every single part of the business. You got to bring it all together. If people would like to learn more about you, where can they find you?
I've got a website, pattontrender.com, and a phone number, 210-822-9977. So love to hear from anybody. I've got a email address, which is info@pattontrender.com.
Awesome. I will put that all in the show notes.
Great.
Thank you so much for joining us today.
Thank you, Rocky. I enjoyed it. See you.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.